Yeah, thank you very much for this great conference and the possibility to speak to you about our experience in Germany in creating the legal basis of borrower-based instruments in the real estate market. I have to say that we cannot give you some account of how to apply these instruments. I just want to give you a flavor of the political economy process if you just want to create the legal basis for these instruments. And this probably foreshadows a little bit the political process that you will face in the future if you want to apply these instruments. Before starting the presentation, just one thing. I'm really glad to see that we are in Europe having national responsibility for macroprudential policy, which also means that we have just competition of ideas and competition of ways of conducting macroprudential policy. And I think we will definitely benefit from these country experiences going forward once we implement, or some countries may implement, these borrower-based instruments. So I think that's a great thing to have a union of otherwise sovereign states with macroprudential policy at the national level. So, what's the state of the German housing market? You have seen the graph yesterday already that Germany's in the long run Germany's house prices are pretty flat compared to other countries. We have not these pronounced swings in housing prices, except maybe one. In the past 20 years, and this was after reunification. You can see that prices sharply increased beginning in 2010, but starting to increase from a very low level. We had very low real estate prices after the collapse of the boom in Eastern Germany. We had not a really pronounced real estate bubble in Germany, but we had a boom in Eastern Germany right after reunification. And one thing that we already heard yesterday was the reason for that was tax incentives. Right after unification, tax incentives were provided by the government to stimulate investment in Eastern Germany. And these tax incentives were big enough to convince people to invest heavily and maybe too much in Eastern Germany at too high prices. But nevertheless, even after the collapse of this boom, there was not a pronounced financial stability issue, even though there were issues in certain parts of Germany. But this aggregated house price increase is not matched by all parts of Germany. So the increase in prices is concentrated in the bigger cities. Frankfurt is one example. Berlin is one example. Even though Berlin had very low real estate prices due to this reunification boom and the collapse afterwards. So that the steep increase in prices in Berlin needs to be considered against the background of the low price level during the 2000s. So during the past 2 or 3 years, the price increase also accelerated in rural areas and in smaller cities. So we have this. So the price increase is spreading out to other parts of Germany, but nevertheless, it's mostly concentrated in the bigger cities. We've talked about that today many times. this price increase is not supported by, or is not mainly credit-driven. So the mortgage credit growth is rather low, especially if you consider it given the low interest rate environment. So one would expect, if you put the interest rate environment into any kind of model, then you end up with much higher increases in mortgage credit. But we don't see that, even though it's starting to increase. The growth rate is increasing over time. So we don't see a pronounced credit-driven development. But I have to say, we lack the data to dig a little bit deeper to see whether there are risk pockets somewhere. So whether there is a huge increase in certain areas or not. We just have the regional, the aggregate data. All in all, the indebtedness of the household sector is also pretty low, and it's going down for the past 20 years or 15 years. We had the peak right at the end of the 90s, and what you see there is a sluggish growth, sluggish nominal growth at the end of the 90s in Germany. And at the same time, households were still paying down their debt from the reunification boom. So we don't see high indebtedness of the household sector. Again, we don't know anything about the different household characteristics because we lack the data. And at the same time, effective mortgage rates are going down and down and down. And this is somewhat a puzzle for us and also for the economics department, whether we do not see sharper increase in credit growth in Germany. Residential investment is also not picking up, so price increases are quite strong, but at the same time we see that it's mostly supply side driven. So there's a supply shortage of houses. At the same time, the demand for houses is quite strong. There are lots of fundamentals that explain the development quite well. We had a huge inflow of workers during the past 5 years, excluding the refugees that arrived in Germany during the past 1.5 years. We just had lots of labor mobility from Europe. About 2.5 million people came net migration to Germany. All these people need houses. So there are at least good reasons why in certain areas prices increase. At the same time, supply is not catching up. As you see that building permits and completed houses are still at a very low level. So the housing sector in Germany seems to look quite okay, but nevertheless, with a low interest rate environment, there are at least the ingredients there, which may lead to a housing boom, also a credit-driven boom. So we have the very low interest rates. So whether you have high tax incentives or very low rates, doesn't really matter if this changes the behavior of people to invest more in housing, to demand more credit. So what we did in Germany, in the German Financial Stability Council, was to look whether we do have the right instruments at our disposal in case something happens. So is a toolbox complete? And we came to the conclusion that we have all the instruments in the banking sector, but we do not have instruments that are based on the borrowers, which are directed at the borrower side. Today, I just received the email. The bill passed the second house of the parliament. So from now on, we will have these instruments. But I come to this in a second. Which instruments these entail? So against this backdrop, the Financial Stability Council recommended to the German government to introduce these tools, especially as a precautionary measure in case that the macro-financial environment may create a situation in Germany where we cannot rule out that we have a housing boom. So the recommendation had two parts. We had one part included the instruments. We had the LTV, amortization requirement, debt service to income ratio, or debt service coverage ratio, depending whether you want to direct it to natural persons or corporate borrowers. We ask for instruments that cover all intermediaries, so it's not only bank-based, but for any kind of lender, so it's beyond banking. Also included is a de minimis, or we ask for a de minimis threshold and excess quota, meaning that that each of these instruments will not be binding for every household, but will be binding for a certain percentage of households, depending on the decision of the bank. So we have a kind of portfolio approach at the bank level. The second part of the recommendation was about data, because we do not have any granular data in Germany. We don't even have good data on price developments in the real estate market. So the basic approach was to include the data collection in the Credit project that unfortunately is now reduced in size and scope, so that this changed a little bit the willingness of politicians to do something right now. I'll come to this in a second. And most importantly, and we talked about this today and yesterday, we recommended to have a structured policy process where you have a mandatory evaluation, ex post activation of instruments to just increase the accountability of all the authorities involved in the macroprudential policy making process. So this was the recommendation, and the government drafted a bill, and this bill entailed most of the things we asked for, we recommended the government should provide a legal basis for. Unfortunately, not for the data. So, given all the data projects at the European level, the government decided not to make any provisions regarding data. So now the fun started. We had the bill in the parliament, and unfortunately, the whole process of drafting the bill coincided with the implementation of the German transposition of the Mortgage Credit Directive. I don't know whether you had some experiences in your country regarding the transposition of this directive, but in Germany we had a hot debate that was fueled by regional banks and also some articles in the media that access to credit was just not there anymore for younger households and also for older households, and this created a situation where people were really unhappy about any restrictions on mortgage credit lending. Unfortunately, we didn't find any evidence that, at least at the aggregate level, that the Mortgage Credit Directive had this detrimental impact on lending. Nevertheless, politicians reacted to that and were very fearful of implementing any further measures. So the draft bill just came into being because it entails modification to the German transposition of the Credit Mortgage Directive, and there was always the risk that the instruments, the macroprudential instruments, were excluded from the legislative process, just because politicians just wanted to have these changes to the Credit Mortgage Directive. So once the draft bill was on the table, we had an intense discussion with politicians. We had the basic question, do we really need these instruments? Because we've never experienced a real estate bubble and subsequent crisis in Germany. The German real estate market is rock solid. And it didn't help, I can tell you, it didn't help to explain to people that there is at least the regularity in the data, the empirical regularity, that most of the crises have their origin on the real estate market. And they said, well, it might be okay that it's regularity, but if you look at the institutions in Germany, they prevent the buildup of any imbalances on the real estate market. So this was not only the position of politicians, but also of the industry, and even consumer protection associations sometimes raised this issue. The other thing is that politicians right now try to increase home ownership. In Germany. You've seen the data presented by Thomas that Germany is ranking. I think it was the third or second last country in terms of home ownership. So there is a political objective to increase home ownership. And politicians said, well, you interfere with our overall goal once you implement these instruments. So this already gives you a flavor of what happens if we want to activate these instruments, given that there might be a financial stability risk for Germany. So the discussion will be very, very heated. So, as I have not too much time left, one important thing was also the discussion on how to ensure democratic legitimacy. The final process, and maybe I can come to that, the final process that is in the law considers a very detailed which steps to take, and the Parliament will have a role in this process of activating these instruments. Basically, it's with the Bundesbank to identify the risk on the real estate market that may give rise to the activation of these instruments. The financial supervisor in Germany, the BaFin, they will have to draft a law saying that we want to activate, and the Bundesbank is in the position to calibrate these instruments once they are once they need to be activated, and we have a veto power in Germany. So in case that someone wants a higher LTV, and we say no, it's better to have a lower LTV, and we cannot agree, then the activation will fail, at least in theory. One thing, we've lost some of the instruments in the process. The Bundestag didn't want us to have, or us as the macroprudential authorities, to have the income-based instruments. So we have no income-based instruments, we have no data. So the question for us now is how to fulfill all the expectations that politicians may have once this bill is coming into effect, because people will think that we are in a position to counter any systemic risk in the future, and probably our ways of counteracting are limited. So thank you.